Let's begin the first panel discussion of the day on the theme Global Trends and Policy Landscape, Reshaping Capital Markets, Trends, Challenges and Opportunities. It gives me great pleasure to once again invite on stage our esteemed session moderator for this session. Please welcome Ms. Nipa, Sheth, Chairperson, ASSOCHAM's National Council on Corporate Bond Market and Founder and Director Trust Group. Once again, a very warm welcome. Joining her on stage are our eminent panelists. Kindly keep the applause going as we now welcome Mr. Amit Ramchandani, MD and CEO, Motilal Oswal Investment Banking Limited. A very warm welcome to you, sir. Mr. Pranav Haridasan, MD and CEO, Axis Securities. A hearty welcome to you, sir. Mr. Bhavesh Shah, MD and Head Investment Banking, Equirus Capital Private Limited. Once again, a very warm welcome to all our distinguished panelists. And with that, I now hand over the session to Ms. Sheth for further proceedings.
Good afternoon, all of you. It's been a very engaging morning, and I think we as a panel have an honor of taking forward the heavyweights, what has been done by Ashish ji, and Tuhin Kande Pandey ji, and BSc MD. So it's been a very, very engaging session, and I think everybody spoke about how capital market has grown over the last few years, and especially from 2019 to 2024. We looked at the figure where the PMS numbers have doubled, the capital raise has gone significantly, the number of demat account has gone to 19 crores, and number of unique investors are 13 crores. And last year probably saw the record raise of the capital, especially in the equity markets, which is significant. And I think we are sitting with people who actually understand, are at the hem of the affair. So great to be with all of you. Thank you so much for being part of this today. And we would start, with a lot of challenges, with a lot of catalysts which will be there for growth. But I think we'll first start with, the broader view each of you have on the subject of today, which is, how we move towards about reshaping of capital markets, trend, challenges, and opportunities. Each of us see a lot of change in terms of how capital markets have behaved, how the financial inclusion is making change, how digitization is making change. And I request you to start, Pranav. Thanks, Pranav.
Thank you, Nipa, and thank you everyone for having us here and being in the audience. I think, obviously, what we have seen over the last 15, 20 years has been unprecedented, but even more so what we've seen in the last 4 years coming out of COVID. And I think what is really changed for the markets is really belief. I think for all of us who've been in the capital markets for decades, one thing is we always wondered how difficult events will get absorbed by markets, how large-scale regulatory changes will get absorbed by markets, and how they will deal with it. I think what we can say with a lot of confidence, having seen how markets have behaved over the last 3-4 years and where we've absorbed a lot of difficult macro news, both geopolitical, global, plus domestic, plus the COVID event that we had, plus all the digitization that we've seen and the pace at which changes have been implemented by market intermediaries and the brokers, etc. And also now, what we've seen over the last year and a half, where a lot of these changes went on board in quick succession. Classic case in T+1, then, we experimented with T+0, plus all of the changes that we've seen. And I think we can say with pretty reasonable level of confidence that we have reached a maturity point where the market is able to absorb these things really well. And I think the classic case that Chairman Sir made earlier in the speech, that the SIP numbers continue to be so consistent. The alternate assets, both PMS, AIF, all of them have consistently gained in size and in pretty decent quantities and measure. We continue to see from a retail investor perspective, all the volatility in the last many months have been absorbed really well. I mean, obviously we see events in 2-3 months prism, it gets difficult to really understand. But when you look at it and you draw a line through the last 4-5 years, I think it's been phenomenal what capital markets in India have provided for investors. And also, I think the both financial inclusion that you referred to and the literacy is really started to pick up. Like, you walk into just random places where nobody spoke about financial markets today. You have young kids talking about difference between trading and investing, So I think it's phenomenal where it's got to. And we've only scratched the surface because we're still only 9% of, the markets really see equity market participation, right? It could easily be in the 25-30%. So I think we as markets mature, we'll continue to see increased participation, even more so from tier 2, tier 3 towns, which is very encouraging for all of us.
Yeah, great. Amitji, can we have your view on this? Broader, ideas on the same topic. So,
sure. So, I think we come from a world where we try and raise capital for all our young entrepreneurs. Over the years, I think we've seen a lot of people trying to raise capital. The initial years was extremely difficult. Now the environment has become extremely conducive for capital raising. SEBI over the years has simplified regulations. In fact, we are probably the only ones which now permit SME listings where you could access capital markets even for a small issue of 5 crores, right? Last year through this route, there was a raising of about 9,000 crores, right? Even in terms of depth of capital markets, we've seen the number of issuances and the amount raised go up. Last year, we did about 3 lakh crores of fundraising, which was almost double of what we did the previous year. Now, even in terms of investing, I think the depth of investors have gone up. While we saw huge selling from FIIs in the last 4 years, about 9 lakh crores being sold, the domestic investors have come in and picked most of it. SEBI's made changes where today domestic investors contribute anywhere between 70 to 75% in any offering. I think with the change in environment, you've seen a lot of tech companies, you've seen a lot of new companies come to markets, raise that capital, right? And of course, the regulation has to keep pace, the compliances have to be there, the checks and balances have to be there, but cannot see any previous times when capital raising was more in flavor, was more accessible than today, right?
Thanks, Amitji. Bhavesh, you have any view here?
Sure. Thank you so much for having us here. What we are going through is a big tectonic shift in the Indian capital markets. If you really look at the last 25 years and see the amount of capital being raised through IPOs, the first 10 years, 2001 to 2010, India raised 2 lakh crores. 2011 to 2020, a similar amount, 2 lakh crores plus or minus. In the last 5 years, that is 2021 to 2025, India has raised 4 lakh crores by way of an IPOs. Now this means that the 20-year amount has been done in 5 years. Now this means a lot of big things, and we are talking about Viksit Bharat 2047. We're talking about our GDP going from $5 trillion to $30 trillion by 2047. Indian capital markets are going to be a big enabler to this growth. We have always seen banks being one of the major instrumental financiers for the corporates. And in fact, that, in my view, led to a lot of disparity of alignment of interest. On one hand, the promoters are looking for long-term capital for their businesses, but on the other hand, the banks are giving loans and they're just taking the interest. We always wanted a capital market which proved to be a good mix or good balance in the corporate finance structure of the companies. Now I think that transformation is happening. In my personal view, as Amit also alluded to, a lot of enterprises are now able to raise capital markets. There's a democratization of the capital markets which is happening in the Indian ecosystem where entrepreneurs can raise money. On one hand, we are seeing a lot of tier 2, tier 3 companies gaining scale, able to raise capital markets. On the other hand, because of the I would say, domestication of the capital flows through mutual funds to SIPs, we are seeing an emergence of the mutual funds becoming very, very big source of capital for that. We earlier used to see capital markets or IPOs being very cyclical. We used to have a phrase called window of opportunity for an IPO. In 3 years, there would be 1 year only when the IPOs will happen. But now, because of the onset of domestic flows, the IPO will be more consistent with little bit of a smaller cycles like what we're going through right now, but it'll be more or less sustainable. Which means that, on one hand, you will have good corporates coming, we are having bigger mutual funds coming, retail participation is happening through institutional flows. So this is all kind of really going to be incredibly transformational change that is happening in the capital markets and which will aid to the growth of 2047 Viksit Bharat.
Interesting. I think from 2025 to 2047, we are going to see this kind of fundraise continuing. Since we are talking about a lot of fundraise, a few questions about IPO, and Amit, I would ask you this, that, on the regulatory issues in terms of pricing, in terms of checklist, in terms of timelines, what has really changed and what are your suggestions in times to come for this?
Sure. So in 2002, when I joined capital markets, we used to take 12 days to complete an IPO, right? From there, I think SEBI's come down and reduced the timelines to T+3. Right? Today, money does not even go out of your bank account before you get allotment. So SEBI has introduced ASBA. We used to have about 1 to 2 crores forms being printed and distributed across the country. People used to take those forms, fill it up, go to the broker, try and get it uploaded, right? All that has changed. Now we live in the digital world. I think we have come a far way in terms of regulation changes that have enabled development of capital markets, right? Simplification of KYC norms for FIIs has ensured that the depth of investors has increased, right? Mutual funds today play an extremely important role because the retail money is flowing into them, right? So the depth of institutions, depth of retail has only gone up. Having said that, we still have a long way to go, right? There are a few changes that would help capital markets access capital, quickly for entrepreneurs. The first could be, the timing itself. Today, when you file a DRHP for raising capital, it takes 3 to 3.5 months for approval. Are there ways to cut down that timeline? SEBI is working towards standardization of document which will help cut this. But clearly that is one area where one could work upon. Second, there are disclosures that are probably not clear around promoter group constructs, right? Those regulations, if streamlined, could definitely help us, right? Third, we have, in the investor categories, today on pricing, you see volatility. You see swings of, so in India, we don't believe in moderation, right? If an IPO gets subscribed, it'll either get subscribed 1 or 2 times, or it'll get subscribed 100 times, right? That's purely because the regulation does not today permit you to give more anchor allocations and you rely on 70% momentum investors. Is there a way to change that? We have successfully done that for OFSs, where we have said we will use the institutional investors to make the book and get the pricing from institutional category, and then subsequently allot to retail at the same price, which has already been discovered. Is there a mechanism to follow similar thing in IPOs? Will ensure a long way in terms of trying to get the right pricing. Also on timelines, as I said, if we can cut down the total process of an IPO from 6-8 months to maybe 3-4 months, that will go a long way in ensuring access to capital.
Great. So, I mean, essentially you're saying the time to market can become lesser and the anchor allocations can become higher in terms of, volatility is what you're suggesting. Yeah. You want to add something?
I have a point to add as well. Very useful points made by my colleague here. And I think I would want to add also around the objects clause. Today, what's happening is there could be an offer for sale by the promoters or the private equity investors. It could be a 2,000 crore issue, out of which 1,800 could be offer for sale. But if there's a 200 crore primary issuance, it undergoes, that 200 crores undergoes a lot of scrutiny by SEBI, and rightly so. But what happens is, you need to, from a SEBI perspective, if you're investing in land, this is the amount. If you're investing in plant, this is the amount. And if you're, it's a very tangible sources of, usage of funds that is being contemplated. However, in the real world, I think companies today, there are so many companies who don't incur capexes. They're all services businesses, but they need capital for growing their business, for branding, including for acquisitions. Now, it's very difficult for any company to say that I'm going to raise 500 crores for an acquisition and publish all the disclosures for the acquisition because it is practically not possible to disclose all the details of an M&A transaction into a public document. I think it may be important to kind of see what's a right way to kind of help companies raise money for those acquisitions, for branding, for non-capex projects where the money is really required. And, in fact, if, we have already seen that the allocation of investors changes. If the company is a profit-making company, it's a 6-1 issue. If the company is loss-making company, it's a 6-2 issue. So loss-making means more institutional investors coming. So same way, if the objects clause, for example, is not a very defined capex objects clause, and if it is to do with usage of money for development of the business, branding, or acquisitions, perhaps the way to do it is encourage more institutional participation in such issues, which basically, with the level of diligence the institutional investors do, there is some element of protection that comes through for retail investors. I mean, this is just a suggestion for the regulators to consider. But I think this is one of the major areas. I think as we think about progress for the country, it's not only just capex, but a lot of other areas that need capital market financing that really needs to be looked into.
Interesting viewpoint. Since we are on IPO, I mean, I would like to take your as well as your opinion on this, that, we see pricing as a very, very important piece while book building. And you see swings across. There are issues which have done very well in IPO. And, even after the very, very big bull market, we haven't been able to catch up. And I'm adding to this, especially what happens to the tech startups as well, because, it's very difficult for most people to go with the traditional PE ratios or, whether it's Swiggy, Zomato, all of them have now huge market cap, Nika. So how do you balance the valuation? How do you advise the investors? And, of course, when you wear a cap of investment banker, I'm sure it's even tougher. So some views on this, because, I think as an investment, everybody looks forward for IPO from the right of when everybody applied of it at par to a long journey of valuations. How do you really look at these?
Oh, sure. I think that's a really good question. I think some of the points that Amit and Bhavesh made were interesting. And I think that whole capital market growth has really come, and it's almost directly, there's a direct correlation between overall retail investor growth. It's almost identical, like the 2000 to 2000, till 2010 story, 2010 to 2020 and so on. I think the most important thing is that from a retail investor perspective, today also 80 to 90% of them flip the book, on a very short-term basis, right? Maybe in the first 10, 15 days of the IPO listing. I think some of the things the regulators have done has been solid, which is the anchor book lock-in, and then they've sort of split that anchor book lock-in now from 30 to 90 days and so on. So I think some of them have actually helped sort of stabilize this, but there's still, from a retail perspective, I think education around IPOs is super critical. And how do you do that? Some of that is by, I think Bhavesh's point that you increase institutional participation that gives some more comfort to the retail investor. But I think fundamentally, the whole DRHP process is just, the whole documentation is so cumbersome for any retail individual to read and understand, right? So I think we need to simplify that communication significantly more to a retail investor. And we'll have to break that into simple risks, right? To say, hey, on the risk metrics, this is A, B, C, D, E, and this is where it fits, right? And why does it fit? So creating a risk framework, I think, would be very, very helpful, just giving them that kind of dimension of thinking, because you need to simplify it. And I think we need to communicate also as market intermediaries a lot more in a simplified fashion to the retail investors, so that they're able to participate in a more educated manner than just follow the herd, right? And so far, and that is why it's either 1 time subscribed or 1,000 times subscribed, because and today also I think most of the analysis have shown that 50 to 60% of retail investing in India happens by looking at the grey market pricing, right? And following some of the websites which actually publish the GMP price. So we need to break out of that, because that is clearly not the direction of travel that we want to take as capital markets in India. So I think these 2-3 areas we need to really work on. And how do we do that? How do we transparently establish a mechanism where we can communicate these things? Most of us are extraordinarily careful because there's no real framework of how do you publish, what do you say, how do I go out and say that this is the risk level, right? Because it's very difficult unless a framework is established to fit in that framework and go and communicate that to a retail investor. So I think pre-IPO, we need to do more work in terms of providing transparency to retail investors, and we need to establish a framework which will be easier for them to understand. I think we've done a lot of work post-IPO, and in listing, and in research, and communication, and all of that. But I think the pre-listing environment needs to get better in terms of investor awareness.
Well, let me ask the investment banker the classic question of retail investor. How do you balance between the issuer and the investor and the pricing expectation?
I think it's a very dynamic world we live in. There are a lot of variables that go into the pricing. It's the investor sentiment, the market sentiment, the perception about growth, the perception about business. One company which may be a star at one point of time will be a dust at the other point of time. So I think it's a very high variable situation that we kind of really talk about when it comes to valuations. However, I think one of the major transformations that has happened in the recent years is when the promoter is going for an IPO. It is the initial public offering. It's the first time an investor is investing in his company from the public side or whatever. Now, the promoter who has built this business in the last 10, 15, 20 years, he looks at it as an acknowledgement of his great business that he has developed. And the intention is that I want the best valuation possible for the IPO. And that is where the big disconnect starts happening with the investors. I think one of the major transformations that is happening in the last 2-3 years, Nipa, is the promoters are starting to realize that IPO is not the end game. It is not that if I get a valuation which is the best, I have achieved very, very big thing in my life. Now the promoters are realizing that IPO is just a start of a journey of a value creation. It is a journey where you're partnering with new set of investors coming with you. It is a journey when you want to share the returns with a new set of investors, such that more such investors keep investing in your company over a period of time. And we have seen wherever the companies have been very pragmatic in terms of their valuations at the start of the journey, we have seen the value creation that can happen in those companies is at a tremendous level. They are trading at levels where, if we were to take the company, same public at that level where it is trading now, it is impossible. Because, the same valuation is not possible. It's more than the best valuation even the promoter would have thought about. So I think this is one of the major changes happening in the space, and hopefully more and more promoters become more pragmatic about this. So we'll see more capital market deals here.
Thanks so much. Would you want to add anything to this? And also a question that what do you think about the SME companies also with this whole set, and what's your SME, you mentioned about the record fundraise which has happened so far and very different for India. And what is the kind of scope and scale you see over the next few years on this?
Sure. So I think pricing will vary. You will have situations of undervaluation and overvaluation, and it's not just now, right? We have seen it historically. Real estate sector, we saw list at huge premiums go down completely, and they've come up slowly. Power, we had the same situation. You have the same situation with some of the tech and digital plays. So understanding of investors, gets better as the sector matures, right? But for us, it is important to get the issues at the right price. Today, the problem is 70% of your offering is going to investors who don't understand pricing at all. They look at that anchor portion of 30% to see if they should subscribe to the issue or not, right? So your offering is being priced by 30% investors who may have different horizons for holding these securities. A lot of people, when they apply in IPOs, they come in with a very short-term outlook of a week, a month, right? It's not necessary that all stories will give you that appreciation within that time frame. So it's important for us to increase that investor education. I think SEBI is now mandated a small film or a video which captures the entire IPO in a few minutes for retail investors to understand. From our side, the effort is also to try and ensure that we go out to retail investors. For example, at Motilal, we believe in our physical advisors going out and advising clients on the IPO rather than online modes. So I'm sure as sectors mature, pricing will be right, and investors will make money. Every IPO we apply for, you cannot get 50%, 60%, 100% gains, right? This has to moderate, and the mentality of investors has to change. At the same time, I believe issuers have become more and more cognizant of the fact they want to also see some appreciation and returns for investors, because majority of the ownership is still going to remain. If they are diluting 25%, 75% still remains with them. So I don't see this continuing for very long. As regulations change, knowledge gets better, and the investors' depth increases. These will correct. Coming back to SME today, whenever you step out, you see smaller institutions trying to raise capital. While SME is a very good criteria where if your enterprise is wanting to raise capital, you are able to easily get it. You are able to get it quickly. I think depth of investors is still probably lacking there. So over a period of time, we expect this depth to increase. Today, retail investors are not allowed, and rightly so, because some of these businesses are not that mature. We see capital being raised being through the SMA route double in the next 3 years, and more issuances come to market from this category.
Great, thanks. While we speak about the equity IPOs and the SME IPOs, I think we must realize that the debt market in its own space has started becoming and raising good amount of money. Last year, we saw almost 11 lakh crore of corporate debt issuance, almost 3 lakh crore of PTC issuance. And today, I think in last 3 years, we've seen enterprise value of InvIT and REIT reaching around 5.5 crore. So quietly, but the thing is there's no retail participation. 98% of these happen as institutional placement. So whenever there's an equity IPO, we see the money getting out of the debt market, because whether RBI allows funding or not funding, the number of times subscription continues to be very heavy, because it takes, the entire system by participation. So while we do this, I think two important questions that we are in the time of deglobalization. I mean, to my mind, the economy with the kind of policies each of the nations have taken, we actually going few steps behind in terms of globalization. However, the financial markets still are globalized, quite related. But we see things like US yields are increasing, and Indian interest rates are going down. And these are the things which we haven't seen for a very long time. So are we really integrated with the global markets, and how the retail participation, or given the number of people we have in this country, can change any shocks or, otherwise in this? Of course, we've seen this in last 1 year to some extent, but what is your long-term view on that?
No, thank you. I've thought about this a lot, because I started my career as a fixed income trader and then ended up in the equities world. So I think one of the key factors why I think the fixed income market hasn't received enough attention from retail investors, one being that obviously in the past the lot sizes were very high, and therefore the ability to participate was limited, which has obviously now become much better. That was one starting point. But through the time that these regulatory changes happened, I think the retail investor got used to returns which were significantly higher, right? And almost in that sense, they took the risk for granted, right? Like they assumed that these are returns which will come to you every year, right?
So as we mentioned, equity is a risk-free return, and debt is a return-free risk.
Yeah, correct. So I think that element of, that, and plus obviously the taxation advantages also have, play a big factor, right? So net of that, it feels like either you go via the mutual fund route and then you find a way to make sure that you get a better tax advantage, but going direct just didn't appeal enough. But I think if markets mature and they reach a point where valuations are sort of steady and sort of trade in this range, and you don't see significant upside, I think debt markets will start to become deeper. And I think all of us have a responsibility to do much more. I'm really hoping that the real turning point for retail participation will come when tokenization comes in, and you're able to break down and fractionalize the debt into much smaller components so that the retail can actually participate, right? And they find enough safeguards in that process to be able to do it for people to promote it and push it further. So I think that will be the debt's moment in my view.
How the equity movement will continue to be with the retail participation going forward is what's your view there?
Yeah, so I mean, see, if you see, the real turning point in the equity markets happened when KYC and digitization and all of that went online, right? And the ability to do that in quick speed. Today, the thing is that, I mean, most of the tier 2, tier 3 addition of accounts that you're seeing, a lot of them happen actually at the time of IPOs. IPOs are first-time investors most of the time, right? Like they're first time to capital markets, not even first time to IPOs, right? So when these guys come in, and they're all coming in mobile first now, right? So they're onboarding them. So we need to be able to make debt mobile friendly, to be able to sell a slightly more complicated instrument digitally. It's not that easy, because I remember it been 15, 20 years back, if you had to sell the concept of YTM to someone versus price versus yield, it's a little more complex, and we have to be able to break that down and make it much granular, much simpler, and we have to do it first time on a mobile app. I think that is the key, and we need to build for that.
Okay. I
have a point on the retail. So I think if you really look at the retail investments that happened in equity capital markets in India, we're talking about 19 crore demat accounts, and single user being 12 crore, as it was cited in earlier speeches. But when you look at, I think there's a big mindset change that is required in the retail investing. Now, if you really look at, we're talking about 12 crore, 19 crore. If you look at the number of registered users Dream 11 has, it's got 20 crore plus. Yes. Okay. So the mindset of the millennials is not that of a long-term investing. It's very impatient. It's very, making, quick money. That's the intention of the retail investors today. I think we talked about a film, Amit talked about a film that, the regulator has made for education. I think a huge amount of emphasis from the regulator side has to be done on making this awareness about equity is not gamification of returns. It's equity is a long-term compounding wealth creator engine. And I think that education is really, really important. Today, India, we are at only 5% of savings going into equities. If you look at US, it is 40% going into equities. So we still have a long way to go. India is a large country, maybe use not only English, Hindi, but also vernacular mediums to kind of get this message across about equity as a product and how it can help you create wealth. I think these are some of the important steps as a regulator and as an investing community we should be kind of focused on.
Nipa, this is one of the reasons why how quickly this whole table shifted back to equities.
Absolutely.
Explains why debt has not taken off enough.
I also think that there's a huge tax advantage apart from, the return which we are looking at. One more question, especially you've been doing a lot of work on the infra side, and then I'll come to Amit for you. Where do you see the global investors coming in for the equity story of infrastructure, and how big do you think that segment can be?
I think for infrastructure, I think one of the major reforms that are needed is really long-term capital. So pension firms, insurance, some smaller tweaks in the regulatory side for them to do more equity investments. They're really long-term investors. I think that can go a long way for helping this infrastructure finance. The REITs already is taken off, but I think that really requires much more education, much more development of those REITs, and of course global investors coming in can really help create financing structures for infrastructure.
Do you see that for the ESG segment or any special segment where you see this?
So today, if we look at infra, till about 5 years back, everyone used to look for funds and they could probably find investors. I don't think that's the case today. You have seen renewables pick up, right? There is 5 gigawatt of capacity that is being put up every year, or that's targeted to be put up every year. There are state financing institutions, there are private equity guys, there are pension funds, there is enough capital there. I don't think there is any dearth of solutions, right? ESG as a theme is gone up, right? There are specific investors who have come into climate, who are either they are climate funds or they are renewable specific funds, or you have some of the PEs which specialize in ESG. So that theme is only going to go up. There is no doubt. Although on the other side you have a lot of wars going on. So at the same time, the defense funds or defense companies are doing well. So themes will come and go, right? But I think availability of capital for these, whether it is infra, whether it is ESG specific funds, we've only seen them go up, and there is no dearth of funds who are investing in India today.
Okay, so over the last...
I just wanted to cover a small point on, while we have talked about listings, while we have talked about access of capital, right? Today there is a very important category of equity investments in the unlisted space. Almost every conversation you have, people want to invest in unlisted equity, right? And that could be as small as 25 lakhs to as high as, family offices doing about 200 crores, right? So I think this channel is come up very quickly, and today if you want to access capital markets, it takes a long time, but if you want to get capital quickly, this is a very, very viable alternative. There are many platforms who are doing this as crowdfunding. There are many investment banks who are doing this from family offices. So I think while we can structure this in a better way, today that availability of capital, even in the unlisted markets, through individuals channelizing their investments in unlisted equities is happening very quickly.
Okay. So, last 3, 4, 5 years, we have seen a lot of work by regulators. We have seen settlement cycle coming to T0, T1. We have seen efficiency in IPO allocations, the fund actually remaining in client account. I'm just going to take a one-liner right now in terms of any specific suggestion for a regulator.
No, I think I agree with you. We have done so much in such quick time in the last 2, 3 years. I think one of the things that my recommendation would be that we pace these changes in a consistent manner and ensure that the market's able to absorb it well as we make some of these changes, because now we're really speaking, most of the fundamental things are really done, right? So now really the question is about how do you pace it in a manner that you don't create too much disruption. So that's one. And I think the consistency with which we do and the message we send to the overall investor community, especially the global investor community, is very, very important. That we are consistent and our policies remain consistent through time. I think that's very, very critical. So that would be my one suggestion. The second thing is that I think for the markets as a whole, there are some areas which require us to be progressive, right? Like some of these capital markets that might be sitting in the periphery. How do we bring them on board? How do we, I think, even as market participants, I'm not sure whether we do enough when these draft papers, etc., are in circulation in terms of giving feedback to the regulators and making sure that some of these points are getting considered before policy is made. And I think that's an area where, as participants, we have got more to do at the time of draft policy making.
Great.
Yeah. So I think we are very blessed to have such a fabulous regulator who has been a guardian of investors over a period of time. And the policies has just been fantastic. I think it's just, as we've covered some of the topics earlier, investor education for more longer-term equity for retail investors is one area I think regulator can definitely work towards. And secondly, on the corporate side, ease of financing through capital markets, which may be non-capex. How can you go about that? I think that's going to be one of the very important areas for the regulator to look at if you want to really go through the way of Viksit Bharat 2047.
So I think for any corporate, it's important to get that predictability in terms of timelines and doability of an issue. You work 6 months, you work a year, either you don't get approvals for the document or your issue doesn't happen because of pricing. I think regulations which can ease timelines, standardize disclosures, and bring that predictability of issue happening will definitely go a long way in enhancing the capital markets participation.
Thank you so much. We'll take one line message to investor for 2047.
Sorry, I missed it.
A message to the investor for a Viksit Bharat 2047, what they should be doing.
I think what is apparently clear is that if you stay the course and stay invested in these markets, just given the growth trajectory, everything, all stars are aligned, right? Just in terms of demographics, the age, where the companies, what's life cycle they're in, where we geopolitically stand in the global context in terms of supply chain, et cetera, et cetera. So I think all of it, I've never seen a time when stars are as aligned. So for 2047, just stay the course, stay invested.
We are here for golden times. We are all very privileged, very lucky to be in this time. And, equities is growth, stay invested.
The entire world is flocking towards India. We are here. Let's make the best of it. And the best of times is still to come.
Great. So let's look towards the golden era with ensuring that individually also there is a lot of prosperity. Thanks a lot for your enriching session.
Thank you.
Thank you so much.